Welcome to another exciting podcast of Steve's Stock Stories. I'm here with my producer, cohort, buddy, Jocelyn Magana.
Right-hand man.
The right-hand man. Anyway, today we're going to be talking a little bit about what you actually look for when you are trying to figure out if a stock is worth investing in. We've talked a little bit about different stocks in the past. And by the way, I'm going to probably say things about stocks today. And when I do, these are not stock tips. They're just examples. So if you want to know more about them, talk to your advisor. You can talk to us, but they're not stock tips. So please don't go out and just go and buy them without, any talking to anybody.
Yeah, basic disclaimer is that we're not giving you financial advice. We don't know you. You'd need to be a client. We'd need to meet with you and know all the intimate things about who you are before we could ever give you advice.
There you go.
And I personally cannot give you advice.
Okay, and because you are not licensed, I am. So anyway, today we're going to talk again a little bit about, what do you look for when you look for a stock? I mean, I've talked in the past podcasts, which, by the way, you can find at, in case you want to get any of these podcasts, at wwmfinancial.com. Or if you actually want to find out about investing secrets every investor needs to know, go to wwmfinancialcarlsbad.com/investing secrets. And we'll give you that a little bit later. But today I want to talk about things like ratios and PEs and dividends and debt to equity and all that type of thing. I'm going to try to make what could be a boring subject into something that's a little more exciting. Okay, so I go back a little bit and I said, I have chosen some stocks in the past that I really like. And what do I look for? All right. Some of the first things that most people look for are things like PE ratios. So what's a PE ratio? It's a price divided by earnings. That's what it is, price divided by earnings. And generally speaking, the higher it is, well, you know what? Let me go back. It's not necessarily higher or lower PE. It's actually for a particular sector that it matters. And you can compare stocks. So for instance, if you want to talk about bank stocks, all right, PEs are generally lower. So an 8 to 10 PE, maybe even a 7 or 6 PE might be something that would be normal. All right, but if you're looking at, a technology stock or a biotech stock, PEs are usually much, much higher than that. You could be looking at 15, 20, sometimes even more than that, depending on how old the stocks, how old the companies are. So a PE ratio is really good for comparing company to company more than just in and of itself. As a matter of fact, I would not use any one single one of these ratios or metrics to say, this is why I'm going to buy a stock or this is why I'm not going to buy a stock. There's many things that go into this, and I think you should use as many as possible. So obviously, when you're looking at a company, earnings are important. Now, some companies that are young don't have earnings, so we're going to start off with companies that do have earnings. So when you're talking about PEs, we talked about that a little bit. You're also talking about something called a PEG ratio. Basically what that is, it's a price to earnings growth ratio. Well, what does that mean? Well, you want to know how much is that price versus how fast is the company growing. And it's not an exact science. The price to earnings ratio, you can know, but you have to guess at what the future earnings growth is going to be. So if you have a stock, let's say, that is a technology stock that you really like, that you think things are great, and it's got a PEG ratio of 1, that is low. That means there's a good possibility, at least if everything else pans out, that stock could go up a lot. So you want to look at the PEG ratio. Again, it's a good thing to compare for the same sector type of a company. So you want to compare banks to banks, you want to compare techs to techs, you want to compare industrials to industrials. Sometimes if you're going to try to compare a bank to a technology company or industrial, you can't do that because each one, based on what the market believes, has a different norm. Okay,
like a benchmark.
It's a different benchmark. That's exactly right. All right, of course, earnings per share is very important. That's pretty easy to do. It's how many shares you have and what are your earnings, and just do the division.
This is like annual earnings in the earnings reports and such?
That's correct.
Okay.
And you can get that Pretty much anywhere. I mean, you don't even have to do much homework on that. All you got to do is look up probably on Yahoo Finance. And
That was the first one I was thinking of.
Yeah, or Google Finance or something, you can get it. Another thing I look for, again, companies that have earnings, I look, do they pay a dividend? Okay, generally speaking, if they pay a dividend, they're usually a more mature company because in the formative years of a stock's growth, they usually want to put all that money back into the company, into growing the company. Once they reach a certain point, they say, okay, let's pay out some of that to our shareholders.
So I'm aware of what a dividend is, but I work here all the time. There are people that might not know exactly. I mean, I think there's a lot of people that act like they know, and they'll nod their head. But what is it?
All right. Well, basically, a dividend is a payment that the company gives you generally speaking, out of earnings.
Okay.
So, whether it's a Johnson & Johnson or a Pfizer or Microsoft or whoever, they have a certain amount of earnings, and they say, okay, we're going to give some of those earnings back to the investor.
Okay.
And so they pay them a certain amount of money per share. Generally speaking, it's on a quarterly basis. Some do it semi-annually, some do it even annually, but mostly it's on a quarterly basis. So they're basically paying you something just to sit there. But again, this is usually for more mature companies. Okay. So when I'm looking at a dividend, so I'm looking at what's the yield? That's the first thing. So how much are they paying me on a percentage basis? So if I put in $1, if I buy a stock for $1, how much am I going to get in
the dividend?
In the dividend.
Okay.
Right.
Like the payment.
Yeah, that's correct. So maybe they're paying me 3%. So if I put in $1, they're going to give me 3 cents for every dollar,
right.
or it's 5%, or it's 1%. So you want to look at that. You also want to see if they've been paying dividends for a while. What's the growth of the dividends? Do they raise their dividends every year? Great companies will do that. Some companies where you see they pay a dividend one year and maybe not the next and whatever, you certainly if you're looking for dividends, you're going to be a little bit wary of that. And probably that has something to do with their earnings in general. You also want to look at a company, at a stock based on their total return. So their total return is how much the company grows as far as the share price is concerned. This is for you as the investor. And how much do they pay you in a dividend? So let's say they're averaging a growth rate in their price of 7% a year, plus they're paying you 3% dividend. Your total return would be 10% a year, which would be terrific. Many, many, many stocks have paid dividends, and a lot of their growth for you, a lot of your earnings come from dividends. Okay, again, these are now more mature companies. Now, if you're looking at companies that don't pay dividends, and let's say they're younger, and maybe some of these don't even have earnings. So, how do you measure that? What I would do is I would look at their sales. And then you say, okay, what's their price to their sales? And that's why when you look at companies today, like an Amazon, for a long time, their stock was just going up and up and up, and they had no earnings. You're saying, why? Well, their sales were going like gangbusters. Okay, and there's a lot of companies like that are young. Tesla was another one here, and I know recently Tesla's been up a lot. Again, please, these aren't stock tips, so these are just examples. But Tesla's up a lot, and before they were even selling cars.
Well, no, I remember these conversations with you years and years ago about the Amazons, about the Teslas, and that it seemed like that was a big deal that they weren't making any money for the layman or the person that's out there on the street that doesn't have a lot of insider knowledge, and I say insider, but meaning in the industry, not like insider trading, but you start looking at and saying, hey, well, these guys aren't making any money. Why? If you're looking at things from a value standpoint, everybody knows Warren Buffett's value investing, right? And you say, well, should we even be buying these things because they're not making any money?
Right. And sometimes this is, the thing about buying a stock and being a stock investor is it's part art and part science. Okay. The science part are the metrics. And then the art part is, well, what do you really think of the company outside, over and above their metrics? So for the Amazons of the world, people thought, well, okay, they're not making any earnings right now, but their sales are growing like crazy. Eventually, they can pull back some of their expenses and start making money. And as a matter of fact, that's what happened in Amazon's case. I think once they instituted Prime, when they started charging, I think it was around $10 a month for Prime, or $10 a year. I can't remember what it was.
No, it was about $100 a year.
Yeah, so I think it was $100 a year. I mean, think of all of the customers that they had that are now paying $10 a month, $100 a year, whatever it is.
It's just built in. It's just a built-in part of life now.
Right, and there is no cost against that. So that really started going toward the bottom line. And now, of course, Amazon is a big winner. So when a company is young, when they don't have earnings, you want to look at their sales. And that's why when the earnings reports come out quarterly, you want to look at those companies. Okay, what were their sales? Are they going up consistently? Or you have to look at, well, did their sales go down a little bit? Why did they go down? And generally speaking, you want companies whose sales continue to increase quarter after quarter after quarter. So that's what you would look at if you're looking at a company that doesn't have earnings. Now let's go back to companies that do have earnings, and we're talking about now margins. What are their operating margins? That's another metric to look at. In other words, if I sell something for $1, what did it cost me to get to market and to advertise it and all that? Okay, so maybe it cost me 50 cents. So I've got a 50% operating margin. Now, that's not company's profits. That's just the operating margin. Company's profits is something else you should look at. And in this case, what they'll do is they take the 50% operating margin and use that for paying things like salaries and rent and all the other things that go into, maybe if it's a product, how much does it cost for that product? So you've got to look at all of those things, but margin is extremely important. Now, again, different industries will have different margins. So again, try not to compare different industries. I think that's the best thing we can get out of this, as far as all these metrics. Compare like to like. So if you got a restaurant stock that you like, Chipotle's, McDonald's, whoever it might be, you want to compare the two against one another, okay? Not against, some biotech company. Or whatever.
Right. You don't want to start comparing Tesla to Chipotle.
Exactly. Okay, so let's talk a little bit about debt. Okay, that was one thing. I told a story about Bed Bath & Beyond. I mentioned that a lot. Of course, today it's not doing very well, but back in the day it did very well. And one of the things I really liked about Bed Bath was that it had zero long-term debt. Okay, now everyone has some debt, because you have current liabilities. You have to pay your bills. Okay, but what debt really means is, how much do you have to borrow longer term to keep your business going? Okay, and by the way, that's going back to the dividends. That's another metric that you might want to look at, because you want to have good coverage of cash flow for that dividend. You don't want that dividend to be coming because they borrowed a whole bunch of money.
All right, and so how would you know that?
Well, you'd have to go to their reports and do your homework. I mean, everything here is in their balance sheets, their income statements, and all that. But you have to do your homework. Okay. It's the not fun part of doing this, but
depends on who you are.
Exactly. But for those people who really say, hey, I want to try to find something diamond in the rough. It's a lot of grunt work, but if you can find it, great. You can make a lot of money in this field. But anyway, so a debt to equity ratio is important. Now, what's equity? Basically, if you're looking at equity, you're looking at really what the company is worth. Okay. So you say, well, how much debt do I have versus the shareholder's equity? And if the debt is way beyond the shareholder's equity, that's a red flag. Matter of fact, I think debt.
So is equity like the value of the assets and cash and those sorts of things? And when we're talking about equity in comparison to the I guess the debt that they're holding.
Well, it does, but the debt to equity ratio, and the reason that this is important is because it's a stock metric that really helps investors determine how a company finances its assets. Okay. And the ratio really shows the proportion of equity to debt a company is using to finance its assets. So you don't want debt to be the reason that you're able to do a lot of things. You really want sales to be more of that
Right.
metric.
So you're not borrowing money to basically operate your company. How do you, do you have any examples of that you can think of right offhand of companies that have been involved where really they were financing their growth and operations with debt versus money in?
Well, a lot of companies use debt. I mean, there are some companies you have to use debt. They're just capital intensive. If you look at, for instance, an oil company,
Okay.
I mean, look at the expense that they have to. So you're going to have long-term
Right.
debt.
Yeah. So if you've got equipment, you've got to finance the equipment.
Correct.
If it's huge oil rig equipment, that's going to be very expensive. You're going to probably need to finance that. Okay.
That's correct. But that's why you want to look at the debt to equity ratio.
All right.
Okay. Now, obviously, you also want to look at what the assets are in the company. Because, for instance, here's a good example of an asset that actually helped the company for a while. Remember, Sears was, at one point was a huge winner. Years ago.
I get a little sad when I think of Sears. I grew up with Sears. I'm really bummed out that they're not doing so great.
Well, Sears and Kmart were two companies that did very well in over time, but they kind of fell out of favor. But both Kmart and Sears owned a lot of land.
All right.
So they had a lot of assets. And when there was a fellow who decided to buy Sears and Kmart, he bought it for the land and the store value, the real estate. It really wasn't because the company itself was doing well.
Now the land, is that the land that the stores are on?
Yeah, they own their own real estate.
So do they have interest in like the big malls, or are we talking about more like the smaller towns where Sears is in Main Street in its own building and such?
Well, I'd have to go in and
Yeah,
really look at
a more complicated question.
Yeah, but if you had a freestanding building, generally speaking,
Right.
they own that building, and obviously they own the land around it.
Yeah, I'm sure there's a lot of towns where they're the main building, or they're the one of four buildings on Main Street.
Right. Well, used to anyway. Now they're probably collecting dust, or maybe they're now an Amazon fulfillment center.
Yeah, well, yeah, I think the malls are going that direction.
All right. So we talked a little bit about equity, and now let's talk a little bit more about free cash flow, because I think free cash flow is one of the most important metrics that you can have. And free cash flow isn't profit. Okay, it is the amount of money that's coming through your system before depreciation and amortization and all that type of thing that you can use to pay your bills. Okay. And the more free cash flow you have, to me, the better. So especially if you have a company that's young, any company, but especially some of these that are growing, and you see that their free cash flow keeps getting bigger and bigger and bigger, to me, that means that everything else is doing well. And that's a company I think I would be interested in. And again, that's a good starting point. So take a look at free cash flow. And let me just read something to you about free cash flow. It's the cash produced by a company through its operations minus the cost of expenditures. In other words, the free cash flow is cash left over after the company pays for its operating expenses and its capital expenditures.
Basically, after they pay all their bills.
Pretty much. And it's also before any kind of depreciation and that type of thing.
When you say that, do you mean from a tax perspective when they depreciate their assets?
Correct.
Okay.
That's correct. Yeah, I'm just looking at cash flow itself.
So does that depreciation that gets lumped into cash flow in certain reports?
Well, depreciation will get into earnings.
Yeah, that's what I'm saying. Okay, so it can kind of muddy the waters from that sense.
It can.
Okay.
The one thing it's hard to fudge on is sales.
Okay.
You have X amount of sales. That's what you have. You can maneuver the books a little bit to get better earnings.
Right.
And you have one-time write-offs. You have all sorts of things. But cash flow and sales, for the most part, they don't lie. All right. So those are very good metrics to use.
No, those are great. I never thought of those too, because you're right. Everybody just looks at least I just looked at earnings and the earnings reports. I never dug in that deep.
Another couple of things that I would use too are beta and standard deviation. Now, what beta means is if the market moves 100 points up, your stock should move the same percentage up. So let's just say it's 1-to-1. Okay. It
Okay.
moves 100 points. Okay. That means that you have the same beta or the same rate of change as the market. If your beta is much higher than that, it means you're more volatile
All right.
than the market. If you're lower, that means you have so if the market's moving one way or another, you're going to move less. All right. Now, standard deviation is actually measures the stock itself. How much does it move one way or the other, not in relationship to anything else. So
the beta is based on the index. Is that what you're saying?
the beta is based on the market, and the standard deviation is just its own thing.
But because there's different indexes, so it would be based on the index.
Well, correct.
Yeah. Okay. I just want to make sure I'm getting that right.
Yeah, generally speaking, if you're using an index, you're usually using the S&P 500. So people will compare how does your stock compare to what's the beta versus the S&P?
Got it.
Okay. So the other thing is standard deviation. Again, if you want a company that's not really volatile, standard deviation is a good one to look at, because let's say that a stock moves in either direction, up or down, within a 20% range, and another stock moves within a 50% range. Well, that 50% may scare you out. It's the same thing as looking at some people look at technical analysis. Now, what's technical analysis? Technical analysis is basically price movement. Okay, so let's say that a stock has a maximum drawdown in a year of 50%. That means that, let's say the stock was at 50 and it went down to 25 sometime in that year. Well, so if you take that historical basis and you say, well, my goodness, it was down 50% and maybe it was up 50%. Do I want to take that much risk, if you will, because volatility is sometimes used as another word for risk, although they're not exactly the same. And you may say, that's too volatile for me. I'm not comfortable with that. And as a matter of fact, what happens in real life is that a lot of people get scared out at the bottom. So if you're one of those people you think would get scared out, please don't go in that direction. The other thing that I look at is what kind of volume do you have on the stock? In other words, how many people are buying and selling this?
I'm smiling right now. Because I think I remember somebody giving me a stock tip many, many, many years ago, and they were so excited about it, and they were telling everybody to buy it, and they told me about it, and I said, well, I don't, since my wife's involved in this business, I don't just go buy stuff without run it by her and her team. And I brought it up to her, and she always shakes her head when I come to her with these things, right? And then she says, well, you should actually talk to Steve about that. And I remember coming to you, and you took a look at the stock. You said, do you know what the volume is on this? And I was like, I didn't know to look at the volume, but I saw the chart. It looked pretty good. It looks the volume. It was some in comparison to the market. I can't remember what it was. It was minuscule, and it was a pink sheet stock, and I didn't know that either at the time.
Right, and pink sheet stocks are basically stocks that are, 1, 2, 3 pennies and don't have much to them.
Yeah, it was funny, and I remember everybody wanted to get in this. They got on this, and I imagine if they did well with it, they were going to told me, but there were no life-changing incidents after that.
No, but volume's important because you want to know how liquid it is to be able to either buy or sell. And you don't want to be, one of 10 people who are buying or selling. And that's, by the way, that's why a lot of the penny stocks aren't good things to buy in general, because the volume on them is so small.
That's where these, what do they call that? People move the market, right? These little chop shops or whatever that you heard about back in the day, that they'd have little teams of people getting people to buy the stock because the volume was so low that they could affect the price, right?
Right. I think there was that movie here recently, The Wolf of Wall Street.
Right, The Wolf of Wall Street. I think they were doing that, and then it all made sense to me when you explained to me how when you have low volume, you don't need that many people to change the price of the stock, which is really scary.
Right, and that what happens is the bid and the ask, the point at which someone is willing to sell or buy the stock widens and widens and widens. So, you may be able to buy it at $3, but only be able to sell it at $1.50. So you don't want to do that because immediately you're out 50%. Now that's an extreme valuation, but it could happen. So what you want is something that trades like water if you can get that. And a lot of the a lot of the stocks, New York Stock Exchange,
right,
a lot of the NASDAQ stocks, et cetera, they have tremendous volume.
What does the volume look like? I mean, just so people have an idea for reference, even myself, because I don't remember what you told me. Well, what is a general range of volume for like a S&P 500 company?
It varies. It could be 10 million, 30 million, 50, 100 million shares.
Yeah, but I know that range, but when I was looking at that pink sheet, I think it was in the thousands.
Oh, yes.
You know what I mean? So and I think that's the big difference that was a big point for me that I think everybody should understand is when you get a stock and you look at the volume and it's in the thousands in this may be the wrong term, but I would call it the more credible, larger indexes of the well-known publicly traded stocks where they need to have audited financials and the whole 9 yards. They're, like you said, they're in that with the 50, 100 million range of people that are or stocks versus 10,000, 40,000.
Yeah.
That's a red flag.
And in some of those cases, it's not even that much.
Yeah.
It could be 5,000 or 6,000 shares, and all one person has to do is sell a lot of it, and the stock can go down by 50% easily. So you got to be really careful about that. Another thing to look at is, people look at growth rates, but you really have to know what it is you're talking about. Let me give you an example of the difference between arithmetic and geometric growth rates. All right. Let's take the example where a stock is up 25%, then down 50%, then up 25%. With an arithmetic growth rate, you're at 0. And when you look at a geometric growth rate, because it takes compounding into effect, and of course compounding matters because in the real world, compounding happens. So again, in that same scenario where the stock is up 25%, then down 50%, then up 25%, you actually have lost 7.9%. And that's much more accurate than the arithmetic growth because, again, compounding happens. We actually talked about this in one of our previous blogs about about some of the
leveraged ETFs.
Correct. And it's the same thing. If you had it for more than one day and you started doing the compounding, you were going to lose almost all the time. So it's the same thing here. So understand the difference between arithmetic and geometric growth. So if you're looking at growth rates, know what you're looking at. We talked a little bit about technical analysis. Some of the things to look at are its 52-week price range, or even longer than that. I like to look at stocks longer, maybe 3, 4, 5 years to see where they've been at. The thing about technical analysis is, to me, it gives you a good metric, but it won't tell you valuations of a company. Okay, it'll tell you just where the price has been moving, and if it moves a lot. That's something else you want to see. If at the drop of a hat, does it move down 10% or up 10%? I mean, just recently we had a company, Salesforce.com, that got added to the Dow Jones, and the stock was up 25% in a day. I mean, that's, that kind of stuff happens. But you don't want to see that happening all the time. That was somewhat unusual. Okay, again, not a stock tip. Okay, don't necessarily go out and buy Salesforce.com. So that's one thing is the price range. The other thing is momentum. People hear a lot about momentum. What does that mean? It basically means that people are buying a company because people are buying a company, or people are selling it because people are selling it. It doesn't necessarily mean anything more than that. But if you're a day trader, momentum can be more important than if you're a long-term investor, in my opinion. If you're a long-term investor, you want to look more at fundamental analysis and certainly less at momentum.
I think there's a big difference too from what you do and day traders do. We were talking about this earlier. I watch a lot of YouTube ads on finance and such, and all the ads come up with some magic system where it's 3 patterns, or there's five dates a year for these stocks, and all you got to do is make 5 trades, or 30 minutes a day, right, and you're going to be rich. I mean, it's just bananas on how many get rich quick gimmick scams.
Yeah, I think the people who get rich are the ones who are selling the plan.
Oh yeah.
Not necessarily the investor. I mean, you may get lucky, but that's about it. So the other thing you might want to look at too is if you're looking to get into a diversified portfolio, is what kind of correlation some of these stocks have to others. Okay, currently, right now, we have a very bifurcated market where technology stocks have done really, really well, and stocks in the hotel and entertainment and restaurant business have done very poorly. So their correlation currently is not very correlated at all. Okay. You generally speaking want to have some stocks or some assets that you have that are not correlated if you want a diversified portfolio. Okay. Now, some people want things like stocks, bonds, gold, real estate, whatever, and that certainly is diversified. Other people may have what they call a diversified portfolio by just having large companies, small companies, et cetera. So depending on what your definition of diversified is. But correlation is another thing you should look at. Okay, here's some other things to look at. What about insider ownership? Are the people who own the company, are they buying stock or are they selling stock? Now, there's a lot of reasons that an insider might sell a stock. It could be for estate planning purposes or whatever. But there's basically only one reason that I know of that an insider would be buying, and that's because he thinks the stock is a good value at that point at which he's buying. Now, it may or may not be, but so when I look at it, and there's ways of finding that, there's companies that follow insider transactions.
Okay.
Also, you might want to look at the short ratio. What's a short ratio? Well, you can short a stock. That basically means what you're doing is you're borrowing stock from someone who owns it. You pay them some interest rate to borrow it. You actually sell the stock first. What you're hoping is the stock is going to go down, at which point you would buy it back and give the stock back to the owner. That's how shorting works. So if you think a company, for instance, Toys R Us was a great company for a long time, and all of a sudden they were losing, ground, you might have said, I'm going to short this stock because I think that company's going nowhere. And of course, eventually went out of business. So if you might have shorted it at $50, which means you sold it at 50 and you bought it back at 0 or 1, you buy it at 1.
Right.
I mean, you made a lot of money. So you want to know, is there a huge short position on there? That could work one of two ways. Either people are saying, hey, this is a terrible company and we want to short it, or it's a good company that maybe is just going through a patch, and you can say, wow, there's a lot of shorts here. They're going to have to cover the shorts or buy back the shares, which will drive the price up. So
where do you find that information at?
Again, you might find it in the Wall Street Journal. You might find it in a Yahoo or a Google page. So, but generally speaking, the Wall Street Journal will have these types of ratios. The other thing is institutional ownership. Are these companies just owned by mom and pop, or is there sponsorship out there from some of these big financial concerns? And I think that's an important thing to know.
So why is that?
Well, because generally speaking, if you've got the backing of these big institutions, there's good buying power and staying power. If the institutions are shying away from it, and generally it's a mom and pop, you don't quite have that same I'll call safety feature. On the other hand, there are certain stocks that mom and pop people say, hey, I'm not selling this stuff. I look at we talked about Tesla. We talk about some of these companies that right now people are saying, I don't care, Amazon, I don't care what you tell me, I'm never selling it. The institutions will sell. And the mom and pops are saying, no, I'm gonna hang on. Now, that may or may not be good for you as an investor, because I don't know who's right and who's wrong.
Okay.
But it just shows you that institutional investor and holding can be a little bit more stable than the individual who goes and buys and sells. So those are a lot of the different metrics. There's a lot more, it depends on how technical you want to get. I love this because if I can get around the microphone here, there are things called the Sloan ratio, the Piotrowski F-score, the Altman Z-score. Let's see, what else do we have here? We have the Sloan ratio. I think I mentioned that. We have the Calamar ratio, the Sterling ratio, the Omega ratio, the information ratio.
Steve, at what point does all this information, when you've got all these ratios, does it just kind of muddy up your vision, or does it not?
No, these are good things to know. I mean, these are people who have come up with a way of analyzing stocks, and the more you can analyze, the better. But sometimes, paralysis by analysis can take.
That's what I mean. So is there a point at which you got information that's a little bit conflicting, and you're thinking, should I do this or should I not? I don't do what you do, but based on all those ratios, I can only imagine. To me, it sounds like when I go into an airplane and I can see the pilot's cockpit, and there's all those crazy dials up there, and I'm like, how does the guy fly the plane?
Right. Well, it can get confusing. To be honest, it can get confusing. But the more of these you know, the better. But again, part art, part science. After you're all done with this, after you've done all the metrics that you think are important, you still have to say, is this a company worth owning? And part of that, I look at Chipotle. Chipotle was one of those stocks that in the beginning, everybody wanted to eat there. It was, good food and fresh food and, the things that people seem to want. Look at Beyond Meat. It was the same thing. Now, whether that's good for long term, whether it's good today or not, I don't know. Same thing with Chipotle. I don't know. I'd have to do more research, and so I'm not telling you to go out and buy it. But look at Beyond Meat. I mean, that was one that took off because people were saying, well,
Oh yeah, I remember that. That blew up.
Exactly, blew up in a good way.
Yeah.
So, so you have to make that determination. And sometimes you're right and sometimes you're wrong. I look back at Netflix and I can't tell you how many people I said, don't buy Netflix. And I look back at it and thinking, how stupid was I? And part of it was because I did the metrics and the metrics weren't adding up to me. But what I didn't figure was that in time, they were going, and this was when they first did the DVDs.
Oh yeah. Yeah. That was a long time ago.
Exactly.
That was a super novel idea. They're the ones who killed Blockbuster.
Exactly right. But what I didn't really figure on was that, okay, they're going to go to the cloud and people are going to pay X amount of dollars per month or per year or whatever it is. I just didn't think that would take hold. Plus, I thought that there'd be a lot of competition. And as a matter of fact, that's one of the reasons I finally bought Amazon, because after learning about not buying Netflix, I said, Amazon's charging for all this, and their Prime included, their TV streaming. So their video streaming. And I thought, okay, that's going to make some money. So sometimes this, even with all of the information that you have, sometimes it's just, you know what? I just like it. Now I hope that that's not the whole reason why
That's not the entire reason. That's not my one piece of analysis.
Exactly. I mean, I know a lot of people though who bought Tesla because they love the car.
Right.
And they thought that everybody was going to like the car. Now, are the valuations today worth it? I don't know. You have to do your homework and all that, but certainly if you've owned it, you've made a ton of money. And I know we've known some people that have owned it since it first came out. And I think it was around $30-35. I don't remember the exact price. And today it's around $2,200.
Wow.
So, I mean, you if you're right, you can make a lot of money. So those are some of the things that we look at. There's more, but I'm not going to go on for hours and hours. I really want to kind of ended it there and just tell you one more time that if you want to get what we have is called Investing Secrets Every Investor Needs to Know, go to WWM Financial Carlsbad with a C.com/investing secrets. And if you just want to check out all of our blogs and our videos and podcasts, go to our website at wwmfinancial.com. So that's kind of it for the day.
That was a lot. It was great though. I learned I learned a lot today. So I enjoyed this myself. I hope you enjoyed it. This was great.
Well, and I hope we didn't bore too many people. This wasn't the typical Steve Stock Story podcast, but hopefully it's a good learning experience.
Well, I've had a few people that I've talked to about what they want to learn. They want to know which stocks that they should be buying and how to figure out if they're getting a good deal. So I'm real excited to share this episode and the last episode, because the last one was kind of like, how do you identify? It was growth stocks, which I thought was really cool. And that was just one sector. That was just growth stocks. That wasn't dividend stocks and so I thought that was great. And because most people that are kind of new to the space, they're probably going to like the idea of growth stocks, at least people that are younger and such, like 40s.
Exactly. Well, I know we said we're ending at this, but just one more quick one. It looks like the millennials have really taken to individual stocks.
They are all over Robinhood right now.
Right.
It's individual stocks.
Individual stocks. They were in Robinhood because Robinhood was giving trades for free, but so does everybody else now.
Right.
Schwab does it. TD Ameritrade does it. I think the Wirehouse. I'm not sure if the Wirehouses like the Merrill Lynch's and stuff do or not. I'm not.
They better.
I'm not sure if they do, but that's available anywhere. But the point is that they are all over stocks, individual stocks, which is nice to know because the previous generation before them was really afraid to go into the stock market.
I think we got Gen X got pushed into the a lot of the mutual funds at that time. That's what I remember hearing a lot about mutual funds when I was in my 20s and such. And I think we all saw the .com bubble and
Right.
was it 2000
And then 2008.
Well, 2008 that was different because I remember how optimistic things were before 2000. It was like there was like a book, The Roaring 2000s. I mean, everything was going to be such a great decade.
Right. Well, and you compare that to right now when everybody thinks that we're, going to heck in a handbasket and the stock market keeps going up.
Yeah, well, we talked a lot about that. So that's a whole nother discussion.
Right. It's another discussion, and who knows, maybe the stock market will stop going up and start going the other way. We don't know. But anyway, thank you very much for listening to another one of Steve's Stock Stories, and we'll be back again. And thanks again. Take care.
It's been great. We'll see you on the next one.